Market Outlook. Calendar Week 24. The review of Calendar Week 23 should be read less as a calendar of events and more as a broader event picture. The week was shaped by macro data, risk reduction, and news that fed into digital assets through interest rates, the dollar, credit markets, and geopolitics. In the United States, the labor market and inflation expectations were in focus. The robust jobs report shifted attention back to the question of how restrictive the interest rate path remains. For crypto, this meant a reassessment of risk, as higher yields and a stronger dollar directly changed the valuation anchor for Bitcoin, Ethereum, and altcoins. At the same time, the discussion around stretched valuations in the AI sector remained relevant. This was accompanied by signs of stress in the credit system. For digital assets, this channel does not operate through individual coins, but through the willingness to hold risk on balance sheets. The Iran conflict remained a geopolitical disruptive factor in the background. The key issue was renewed sensitivity around energy, transport routes, and the Strait of Hormuz. For crypto, this creates a mechanical transmission channel. Higher financing costs and a stronger dollar reduce risk budgets, while thinner order books amplify moves in altcoins. The current market structure can be summarized with two markers. Bitcoin dominance stands at 59%, while the Crypto Fear and Greed Index is at 12, placing it in the extreme fear range. Capital therefore remains more strongly concentrated in the most liquid segment. Quantum data analytics did not develop any research signals in this environment. The reason was operational. The market regime was event-driven, with moves coming from macro data, credit stress, derivatives deleveraging, and geopolitical headlines. This increases the risk of regime misclassification. For that reason, filter adjustment and retraining were the main focus. Signals were not activated because stable patterns were overlaid by rapid cross-asset reactions, thin liquidity, and shifting news channels. The outlook for calendar week 24 focuses on clearly defined event windows. On Monday, German factory orders and New York Fed inflation expectations are in focus. Both data points touch growth and rates, while the US figure also affects the dollar and real yield channel. On Tuesday, Chinese trade data and German industrial production follow. These data provide signals on global demand, commodity channels, and European growth. On Wednesday, the US Consumer Price Index is released. This window directly affects the rate path, treasury curve, dollar, and valuation of risk assets. On Thursday, the ECB rate decision, US producer prices, and initial jobless claims are scheduled. The ECB acts through the euro, bond yields, and global financing costs. The US data complement the inflation and labor market picture. On Friday, German inflation data, UK GDP, Michigan sentiment, and Chinese credit data follow. The geopolitical situation remains an ongoing disruptive factor, as energy prices and transport costs affect the same inflation channel. For digital assets, these events work through the same mechanism. Data change rate expectations move yields and the dollar, and from there, pressure or relief emerges for Bitcoin, Ethereum, and altcoins. From a crypto-specific perspective, token unlocks, ETF flows, and funding divergences remain relevant. Stable, Solana, and Sui provide supply impulses, while recent Bitcoin ETF outflows weigh on the spot channel. Different leverage distribution between BTC and ETH increases liquidation risk when spot moves and derivatives positioning react at the same time. Operationally, the sensitive windows are mainly around US data at 12:30 and 14 o'clock UTC, around the ECB event on Thursday midday, and during the Asia session around Chinese price, trade, and credit data. In these phases, slippage increases as liquidity is repriced, and order books in smaller altcoins thin out more quickly. ETF flow windows after the US market close remain relevant because spot outflows pull the derivatives basis along with them. For research signal development, the framework remains cautious and strictly data-driven. Only phases in which market structure, liquidity, and event windows align are relevant. As long as macro data, credit stress, and geopolitical headlines affect the same pricing channel at the same time, avoiding false activation takes priority over signal frequency. This post does not constitute investment advice, contains no buy or sell recommendation, and is intended solely for informational and research purposes. Quantum data analytics. Analytical, strategic, innovative.